Welcome everyone to another episode of Quant Insider Podcast, your go-to resource for deep dive into quantitative finance, trading, algo trading, quantitative trading, and place where we get best of the best people from industry to learn a practical insight and move beyond theory. So today we have very special guest with us, Ben. Ben is the founder and CIO of QVR Advisors. Ben has built QVR Advisors into one of the industry's most reputed volatility-focused hedge fund. In today's conversation, we will be exploring some of the most nuisance and less discussed topic in vol trading. So we'll be covering up from volatility service modeling and finding mispricing, understanding about option pricing in theory versus how it works in practical, and how structural volatility flows in the market affect and the key players flows affect the volatility and its pricing, and how dealers and hedge dynamics affect the overall market volatility. And then we will move into macro and geopolitical volatility drives, analyze how recent geopolitical events and macroeconomic shifts are impacting volatility markets today. If you are someone who likes to get deep dive into vol trading and these technical topics, this is the play. This is the episode you should definitely watch. Welcome once again, Ben, to the Quant Insider podcast.
Yeah, thanks for having me. It's going to be fun.
So we will just start with your journey, right? So you did your PhD in economics and then you moved to vol trading. Can you just give me brief about your journey, like how you got interested in vol trading and like what get you started actually in trading? What was the driver that got you into the industry?
Sure. So I was a development economist by training a long time ago. I worked for the World Bank for years. I went back to Berkeley to do a PhD. About halfway through my PhD, I just sort of realized that while, development and poverty is super important, like, the impact that some kid from California writing, academic papers about it was not very high, right? And I should just do something that I'm good at and that's fun. I started teaching in the Master's in Financial Engineering program at Berkeley, teaching statistics and econometrics and credit risk modeling and just teaching myself stuff. And that was pretty fun. I had a former student who went to work for a hedge fund and who asked me to come help them, do some work. And so, got into the industry that way. And then when I finished my PhD, I went to work on the Wells Fargo proprietary trading desk. I was a quant at the time. I ran the quant desk, and then when John Laughlin, who had started and run the Blue Mountain Equity Alternatives Fund, he joined the firm, which at that point had become a hedge fund that had spun out of Wells Fargo. John and I got along really well, and I left running the quant team to work for him as his sidekick. And he was my mentor, and he was a volatility and derivatives trader. And so that's where I started to learn all of this stuff.
Oh, that's why you are very good with explaining concept on your Twitter threads very well. Like you have a teaching experience, so that's why you are very good with those. Because your threads have been like very educative and like it's been very good. Even I've learned a lot from your threads. So yeah, I think that's because you have experience of teaching. That's how you're able to explain stuff very in a very nuisance manner and very clear with very much clarity. So before we start with all the technical stuff, first I would like you to explain what exactly is volatility because a lot of people have misconceptions about volatility. First, I would like you to explain what exactly is volatility.
Yeah, when people refer to volatility, generally they mean the movement of asset prices, right? And so not the direction, not whether stocks go up and down, but how much stocks move, or currencies, or commodities, or any other type of asset, right? And volatility is something that can change a lot over time. There are obviously market environments that are very quiet, and asset prices don't move very much, and then there are very chaotic periods of time where asset prices move a ton, and that inherently is what volatility means. When people talk about volatility trading, usually it, I think, more generally means trading what we would call higher moments of the distribution of asset prices. So volatility is what we call the second moment in statistics. And then there are things like skew and kurtosis and other higher order relationships with how asset prices are moving that aren't just the direction of asset prices. So that's really what volatility is about.
Okay. Now we have just you have touched this skew, right? You can just give a brief what is actually a skew. So in future, when in the past we were discussing about these things, so people can understand what is a skew. In just in statistics terms, like a basic example and stuff you can give.
Yeah, so skew in statistics terms is going to be a third moment of the distribution, which is going to be how you could think of it as how volatility changes with spot prices in a finance context. And so typically, if you think about equity, typically markets get more volatile as they go down and get less volatile as they go up. That's why typically there is inverted skew in the equity markets. In other words, the implied volatility of out of the money puts is higher than the implied volatility of out of the money calls.
So you sometimes joke about QR intern assisting with volatility surface fitting, right? For our broader audience, can explain what exactly is volatility surface? What does it mean to fit a volatility surface? And why is the shape of a wall surface so crucial for option trader in finding a mispricing?
So the volatility surface, what that means is it's just you think of calculating the implied volatility of every option that trades on an underlying, like the S&P 500, for example, and then parameterizing those by the time to maturity of the option on the one hand, and also by the strike price of the option in the other dimension. And imagine a three-dimensional picture that shows the implied volatility of options by their strike price and by their time to maturity. And that shape is what's called the volatility surface. And that shape tells you what the market is pricing in terms of volatility now versus volatility later. So whether we're in a quiet market and we're worried that things will get more volatile in the future, or whether we're in a very noisy, crazy market right now and things are expected to get calmer over time. So the term structure of volatility in the time to maturity dimension, and then the skew is in the other dimension in the strike price dimension, right? So how are markets pricing downside volatility versus upside volatility, and the volatility surface just contains a normalization of all the information that's in option prices about a particular underlying. And certainly for volatility traders, that's kind of the basic unit of data on how the market is thinking about and pricing what's going to be happening to a particular stock or a particular currency or a particular commodity.
So can we say that wall surface is able to capture a lot of information of the market, like how market is going to move, what market is pricing? So do you think volatility surface are good at understanding basically what market is pricing in the market and how and what information in the market they're able to capture it?
Yeah, very much so. Markets are relatively efficient, these days in in the United States anyway, for the most part. And to first order, the volatility surface is going to give you the best simplest forecasts of realized volatility over different time horizons, and of how implied volatility will move as the market rises or falls. The volatility surface captures that information, fairly well.
All right. So you've said it. It's better to forget that you ever had sticky delta or a sticky strike in wall heuristics. Can you explain the pitfall of those traditional rules for updating the wall surface as market moves, and how should we think about wall surface evolving, if not by a simple sticky assumption? And yeah, before that,
Yeah.
I just want you to explain
Mhm.
what is sticky delta and what is a sticky strike. So people who don't know about those can just understand your answer first.
Sure. So they're just simple heuristics, and there's nothing wrong with them as simple concepts. The problem is when you treat them as like assumptions about what will happen, right? So sticky strike simply means as the market moves, the volatility, the implied volatility curve stays the same at a particular strike. So say the S&P is at 5,500 or something. If we rally, the sticky strike model says as we rally, implied volatility on that 5,500 strike stays the same. Sticky delta would refer to a floating strike volatility surface. So delta or moneyness are floating strike concepts, because as the market moves, the at the money point is changing, obviously, right? So it floats with spot as opposed to its fixed. So sticky delta would imply that as the market rallies or as the market sells off, the 50 delta point, for example, would keep the same implied volatility, but the fixed strike options would actually change. And both of those are just think of them as reference points. They're fine as reference points, but neither of them certainly is like a model of or an assumption of about what will happen or what should happen. They're just sort of descriptive things, right? And so when you think about what will happen to the volatility surface as the market moves, that's primarily an empirical analysis question, right? So you have to look at data and you have to estimate different relationships about how different points in the volatility surface might move as spot moves. And you can also look at skew, which gives you a market implied change in implied volatility as spot moves with some nuance in the calculation. So it's nothing wrong with like the basic concept of sticky strike and sticky delta, as long as you don't think that's like, oh, is the market going to behave like that? Of course it's not. Those are just sort of reference points.
Okay. You touched on the point of skew, right? So do you think there is skew have a predictive power? Like, can it predict the direction of a market? Does skew hold any predictive power in the market statistically?
In general, there's very few things that predict the direction of the equity market over short periods of time, right? And if you think you found one, then you've fooled yourself, because the S&P 500 direction on a short-term basis is very efficient, and like you're not going to be predicting it with like something in the option market. Skew doesn't imply anything about the option market or about the stock market. What it implies is how implied volatility could change as spot prices change, and it does a very good job of forecasting that.
So again, on skew, I will want to touch. So implied volatility skew is often seen as just put expense relative to calls, but you pointed out the skew actually reflect the market implied covariance between returns and volatility, right? In practical terms, what does a steep or a flat skew tells us about how the market expects this asset to behave in down versus up moves? And how can trader use this insight in positioning?
Mm-hmm. So a very steep skew curve, steep to the puts in equities, for example, implies that implied volatility is going to rise a lot as the market falls, and it's going to fall a lot as the market rallies. Vice versa, a relatively flat curve or even an upward sloping skew curve, like you might see in Tesla or a meme stock or something, for example, would typically imply that implied volatility either won't rise very much, to the downside, or even actually as it rallies, the implied volatility might get bid. Right? Again, you see that a lot in meme stocks and things where retail is bidding aggressively for upside. And so again, the skew curve is generally pretty efficient about pricing those kind of expectations in.
Okay. Another thing, like you do talk about dislocation, right, in the volatility surface. So when scanning the surface, how do you spot a genuine volatility dislocation? And could you share an example of a subtle mispricing on a wall surface that might look that many might overlook? Like sometimes you just scan the wall surface and we might have missed that kind of a mispricing in the wall. And for instance, you have also noted just because Q is at the first percentile of its, in one of your tweets, I remember you were talking about this, that just because Q is at the first percentile of its history doesn't mean that you will make money owning it. Because there is what we call as negative carries there against us, right? So what separates the optically cheap option from an actually mispriced opportunity? Because sometimes people just get confused in that, or they just take uh, they just take any other thing as a mispricing and just try to trade on that.
Mm-hmm. Yeah, so I'll answer the second question first. So again, this just comes back to, again, the fact that the market is pretty efficient, right? So if skew is low, it's low because realized skew is likely to be very low. And if it's high, it's because realized skew is likely to be very high. You need more of an insight than that to have a good trade, not just, it's kind of like the dollar stock price is high versus low. Should you buy it when it's low and sell it when it's high? It's more complicated than that, right? Now, in terms of understanding and spotting dislocations in volatility surfaces, I would describe, two kinds of things. So one, if you're a high frequency, option market maker, then, you can see in very short periods of time if, for example, options that are very close to each other in strike price suddenly, trade at very dislocated levels where, a butterfly is negative or something like that, right? And so they have the speed and the ability to trade quickly and without transaction costs that they can like arbitrage away those kind of opportunities, right? That's very specialized. And all you need to know there, obviously, is option prices and the volatility surface. But that's not the kind of thing that most people can do, nor most even volatility hedge funds necessarily. The like larger dislocations and more slower moving dislocations are, things that generally, in our case, you need a few different things to really understand what is a dislocation. You need to understand what is the flow that is driving some parameters in market prices to relative extremes. So like, for example, and we'll talk about this a little later, but like, there might be very large call overwriting programs from ETFs in NVIDIA, right? There's this yield max ETFs, right? And so there's big size selling the 1 month point in the upside calls. And so that flow exists, and then you can look at the volatility surface and see how it's relatively steep, in the front where the front end is getting depressed, and you can look at the shape of the curve, the steepness in the front versus the steepness in the back, understand where that's coming from, and then think about what kind of a trade you could, construct around that. So like, it's generally hard without any context to just look at a volatility surface and be highly confident that you see a dislocation or a mispricing, as opposed to just, the market's expectations, which are kind of reasonable, right? You need more information than that.
Also, you touched on the concept of volatility free or like arbitrage free wall surface and butterfly, right? So I think a lot of people in our audience might not know about what is a arbitrage free volatility surface and the concepts of butterfly. So can you just explain the concept?
Sure, exactly. So arbitrage is a somewhat theoretical concept, right? But like in any kind of sensible world, let's think about just a simple option butterfly, right? Where you own one strike, you're short two of a nearby strike, and then you own the next strike down, and so you have a payoff that's like a little tent that's strictly positive no matter what happens. That butterfly has to trade at a positive price, or at least zero, and probably more than zero. If it's strictly more than zero, and if that butterfly is trading at a negative price for some reason, that would be a violation of arbitrage principles in option markets, because you could put on that trade, you would never lose money under any circumstances, and possibly you would make money, right? And so certainly if you're a high frequency market maker, you're continually enforcing those arbitrage boundaries, right? And if there's any small arbitrage boundary, you're putting it on and then taking that opportunity out of the market.
Okay. Got it. So now we can move to the next section, which is basically option pricing. So basically in one of your Twitter thread, I remember you call Black-Scholes as the big daddy of elementary confusion. So you emphasize we use it as a model. Not we don't use it as a model, but as a normalization for option prices. So can you explain what that basically you want to explain, like, for our audience, and why Black-Scholes is still useful for quoting implied volatilities, even though real market volatility assumption is in obvious ways? Like, it's basically
Yep.
volates, right? Because it assumes that the volatility is constant, but our volatility keeps changing. So it basically violates that assumption. So why it's still useful for quoting implied volatilities?
Yep. So this is very, very important, right? The way that the market uses the concept of Black-Scholes or Black 76 is not in the context of a model or a description of reality or how things happen. It's literally a accounting normalization, right? So you think of, we have all of these different option underlyings, we have all these different maturities, we have all these different strikes, and you have option prices. And what does it mean that this option trades at $72 and this option trades at $4? It's impossible to draw any conclusions from that, right? Black-Scholes implied volatility simply transforms, dimensionality reduces all of that information into one number that's comparable in a meaningful economic sense across different underlyings, across different maturities, and across different strikes into 42% versus 30%, and that has economic meaning, right? And it, of course, very clearly, there's no assumption in the market that Black-Scholes is true because by definition, the volatility surface is looking at what is implied volatility as a function of time to maturity and as a function of strike for a given underlying, right? And so all of the interesting, work that we do just normalizes option prices in a useful, economically meaningful way into implied volatility, and then tries to understand why is the volatility surface the shape that it is, what kind of dynamics we expect it to have, and so forth, right? So when somebody says, oh, you're using Black-Scholes, but volatility is not constant, does that make sense? That's totally besides the point, right? Nobody makes any kind of assumption that volatility is constant. Of course, we're looking at a volatility surface. By definition, it's not constant.
Okay. Also, I want to understand if I as a trader, right? I'm not an institutional, let's say I'm a retail trader, okay? And I'm trading options, vanilla options like SPX options or NASDAQ options or equity options, plain vanilla options, just call puts, okay? So and I want to find I want to build a strategy using mispricing in the option, right? I want to get my own basically calculator, like my own option pricer, and I want to find mispricing by seeing like, okay, my market is trading at this and my pricer is saying this. So do you think someone can use Black-Scholes for that by making certain changes, or they should look for something like Heston model or any other similar model?
I think you should never try to do anything like that, right?
Yeah.
Because all
Okay.
you're going to do is have some model, and it's
Okay.
going to be significantly different than market prices because it's a poorly underfit model, and you're going
Yeah.
to show differences, and those differences are random and meaningless, and then you're going to trade and you're going to lose money, right?
Yeah. Okay.
You don't find mispricings by fitting some model and assuming that you're correct.
Got it. Got it. Okay. That another thing which I wanted to understand about, we calibrate the model, right? When we build any model, we calibrate it. So can you just go through a process of a calibration? How do we calibrate actually a model?
So there's different kinds of models. So I'll describe two different things that one might do. One thing you might mean by a model is just a smooth fit, a smooth economically meaningful fit of the volatility surface, right? So you have obviously different options. Maybe you have a little bit noisy prices. Maybe the bid ask is skewed in some of them, right? And you don't want to assume that true mid market is just the mid of every bid and ask on every option. You want to fit kind of smooth curves through the volatility surface, right? And so that's going to be potentially some combination of like a statistical interpolation exercise where you're doing some data cleaning, where you're making some assumptions about what the shape of those curves kind of should be and how to kind of draw those curves through the bid-ask spread channel. So that's one kind of model. The other kind of model is where you are trying to fit some kind of a stochastic process, right, like a Heston model, which you brought up. And then the key question is, what are you attempting to use this model for, and what should you be doing? Generally, if you are trading options, you should never touch any kind of stochastic model calibration. It will not add any value to anything that you do. The reason that you use a model like that is because you work on an exotic derivatives desk and you need to price things that don't exist in the market by fitting a model to vanillas and then implying some kind of a price for an exotic option. And like that's the use case that you would have for a stochastic model. And then you have to be very careful and think about all the corner cases, and you probably have multiple models and compare the prices and all this kind of thing. But for vanilla options trading, really all you want is a nice, clean, smooth volatility surface without any material assumptions.
Okay, got it. So next question which I have is that in traditional theory, we assume that we do continuous hedging, the prices are distributed log normally, and there's a constant volatility, which in practice basically absurd, right? Because real market doesn't hold these assumptions true. So what are the biggest divergences between an option theory and actual market behavior? For example, how do traders account for fat tail jumps, change in volatility, like volatility of volatility, and the basic model doesn't capture that a basic model doesn't capture?
No, that's a good question. So generally, no one in the market would attempt to delta hedge continuously or believe that you could, right? Both because of transaction costs and also because you may want your option trading P&L to be more reflective of realized volatility over longer units of observation than sort of very tiny periods. So you may, for example, volatility of daily returns. So, let's suppose that you're hedging a volatility swap, for example. A volatility swap's returns are based on daily returns of the underlying, right? So the volatility calculated from daily returns. So when you're hedging a volatility swap, the only thing you would ever do is hedge with options, delta hedge them on the close once a day. You would never hedge continuously. Otherwise, you would be introducing total random noise into your P&L. You have to match the observation window of the swap, right? So there isn't really an issue of like having an imperfect model here, right? There's just some set of risks that you can hedge and other basis risks that you can't. So, for example, like the volatility swap might trade at some kind of basis to its theoretical price under whatever model that you have, right? Driven by supply and demand. If everybody wants to buy volatility swaps, they'll become more expensive relative to options and vice versa. And that basis might be something that you explicitly trade as an options trader, right? So you might wait until that volatility swaps get really expensive. You might sell them and buy options against them. If they get really cheap, you might buy them and sell options against them. So there's no question of like, oh, the model's not perfect. It's just the way that the market works, right? And there are certain risks that you can hedge perfectly. There are certain risks that you can't hedge. There are basis risks that are left. Those basis risks are interesting for trading and for all kinds of things.
Another thing is that there is always a choice between doing a discrete or a continuous. Like continuous, anyway, nobody does it. We do generally discrete, and we do in a regular interval or some interval which we have. So how does one decide to get a parameter, or what parameter they can use to come up with a interval for discrete hedging?
Mm-hmm. Yep. So how you hedge deltas really depends on what your strategy is, whether you're hedging some other instrument, whether you're not. Depends on the dynamics of market behavior, and depends on your risk management. So, for example, whether there is expectancy to a shorter or longer term delta hedge window is going to be driven by how kind of mean reverting or momentum-y is the market over a short horizon of time, right? So you might have some kind of model-driven view on that. That's relatively hard because it's sort of picking market direction over a short period of time. Again, that's a relatively hard thing to do. If you were really good at that, you wouldn't bother with options, right? You would just trade stocks and know when the market's going up or down. But so you're really trading off transaction costs against potential risk. There are some market environments when, under extreme cases where you might have a relatively informed view on trendiness. For example, in a market where, it's very volatile, dealers are very short gamma, there's a lot of leveraged ETFs, you might expect momentum into the close, as opposed to kind of mean reversion into the close. And so you might want to let your deltas run if you have a long gamma position, or vice versa. There's a lot that goes into this. A lot that goes into that sort of question and calculation, but what you're always managing is trade-offs between transaction costs, risk, and any potential view you may have over a short period of time on the direction of equities.
Okay. Another question again related to continuous hedging. I think it's really one of the last questions related to that. So in theory, like one can delta hedge continuously to manage an option risk, right? But we know that the transaction cost comes into the picture, the liquidity comes into the picture, and it's impossible to get a perfect hedge. Like nobody can do it. Perfect hedge is like it's impossible. So let's if you can illustrate with an example, say trying to replicate a volatility swap with a vanilla option, and why smile delta and other second order effect make it tricky, and how do a practitioner hedge in real world without a perfect model?
Yep. So smile delta is a good example of something that you need to.
Sorry to cut you, Ben. Can you just explain what is smile delta for our viewers first, and then we can go into that. Yeah,
I will. So it's something that you have to understand. You don't necessarily have to hedge it depending on what you're doing, but you need to understand what it is and make a conscious decision. So smile delta relates to the fact that if you have an option, it has a particular strike and it's going to price at a particular implied volatility that's going to be partly driven by where that option is relative to spot. So again, if there's a lot of skew in the S&P, for example, if that option is further out of the money towards the put wing, towards the downside, that option will trade at a higher implied volatility and vice versa, right? So let's suppose that the market rallies. You own this option. Let's suppose that the market rallies and the implied volatility surface, the floating strike implied volatility surface by delta stays the same, right? Then what's going to happen is your option is going to be further out of the money now because it's a given particular strike. Now the market has rallied, so your option is kind of moving to the downside in the strike space, and that option will trade at a higher implied volatility because now it's a further out of the money put. It's rolling up the skew curve, right? And nothing about this depends on some kind of assumption that the volatility surface doesn't move. Whatever happens to the volatility surface, that option is going to be pushed to a higher implied volatility by the stock price rally and the fact that there's skew. And then that option has some vega, obviously, so you're going to make some money from that. From the fact that you own this option, it has some exposure to implied volatility, and the vol is going up. So that is a skew delta effect, and it's very mechanical. If you are hedging a volatility swap with options, for example, you have to completely hedge your skew delta because the volatility swap doesn't have this skew delta effect. The volatility swap is just floating. It's not anchored to spot in any way. But your options will as you rally, the options will become lower strike relative to spot, and as you sell off, the opposite. And so you have to hedge that skew delta. Now, if you are just trading options directionally, you should know that you will have this behavior rolling up and down the skew curve. You can make a decision about whether you want to hedge that or not. It's not, you're not trying to replicate floating strike volatility behavior. But it becomes important, for example, if you buy a tiny strike, a very low strike put on a very steep part of the volatility surface, if you were to delta hedge that put, you almost expect that the volatility of that put doesn't change, as the price of that put almost doesn't change as the market moves. So you really have to understand how you expect these things to behave, understand skew delta, and then make a decision. Given my particular trade, do I want to hedge it? Do I want to hedge all of it? Do I want to hedge part of it? So again, these are subtleties that a lot of people just don't think about.
Okay. Next question, which I have is basically, so you have been in industry for a very long time. You have very good experience in the industry. So as per you, what is a common mistake that traders or fund makes when they apply quantitative models to options? Are there cases where a too naive application of Greek or misinterpretation of a model output led to big loss?
There's lots of first order thinking or sloppy thinking in derivatives markets for sure. We talked a little bit about one of them. Again, I think the most common trap in volatility in derivatives markets is this idea that if implied volatility is high, it must mean you're supposed to sell it. If it's low, you must be supposed to buy it. Same thing with skew, same thing with correlation, right? Again, markets are not that inefficient. Lots of people just can't possibly believe this, right? They think that if volatility is high, you have to sell it. In many cases, the most profitable times to buy volatility actually occur when volatility has gone up and is relatively high compared to where it was before. So this, I think, is the biggest source of misconceptions and first order thinking for people who haven't done the work, done the research, had the experience in the space for sure.
Yeah, so basically a lot of people make assumptions just on first order thinking. They don't actually go to the second order impact and third order impact of a particular assumption or the strategy which they're building. They just go with the first order assumption that, okay, the skew is at 90%, let's just sell it, or the skew is at 10%, let's just buy it. So these kind of a thing, they just think about the first order impact of that. They don't go for the second or the third order impact of that. Got it.
Yeah, that's right.
Yeah, before we move to any other question, actually, I want to understand the reason behind you have the wall behind that you have the bridge photo, right? So what is the reason? Even on the website of the company, right, on the QVR Advisor, you have this image. So is there a story behind it, or it just you have put it? What made you decide this image?
Well, we're based in San Francisco. That's the Golden Gate Bridge, which is probably the most famous, landmark in San Francisco. We are you can't quite see it from we can see the Bay Bridge from our office. We can't see the Golden Gate, but it's just a beautiful piece of the natural environment where we live and work.
Okay. Oh, and I thought there might be some story that you have put this image, so I just asked. Okay. Yeah. So next section which we will talk about is structural volatility flows in the market. So as per you, who are the players in the market who affect the flows? And the volatility market isn't just like we just don't have speculators, right? We have people who want to hedge their exposures. People like we have pension funds, we have long only funds who want to hedge their downside risk, and we have, like you can say, particularly people in commodities market who have certain exposures in the real world and they want to hedge that risk as well, right? So these are the people who actually affect the flows. So like as per, so who are these big and also who are the big systematic vol sellers and buyers, and how do they affect the volatility flows?
Yeah, no, that's right. Ultimately the derivatives markets, exist because of end users of derivatives, not because of arbitrageurs or vol traders, right? I mean, sophisticated vol traders are a very small part of the market. When you think about end users of derivatives, there are a lot of the things that you mentioned, right? There, companies hedging their commodities price exposures and farmers. They are retail investors buying structured notes for, to generate yield. They are big institutional investors doing call overwriting or cash secured put
Yes.
selling via managers as equity replacement, right? And the sizes of these trades are massive and totally dwarf what arbitrageurs are, and the whole role of relative value arbitrage volatility managers in the marketplace is understanding the imbalances in those flows and providing liquidity and helping to correct dislocations in the market or take the other side of dislocations in the market to kind of keep prices from getting out of control, right? So that's really where all of the edge or all the alpha in the space comes from. It's not from guessing what's going to happen in macro and buying the right options or something like that.
Okay. So basically, it's like, so when we talk about dislocation, we basically try to find like how these players, movement or flows are going to affect this overall volatility, and we try to find trades based on that, right? It's basically what
Yep.
dislocation is. Okay.
Yeah, that's it. That's exactly right.
Yeah. And next is basically like, right? There's a huge which the people of like huge number of people are just selling volatility nowadays. Like everybody's option seller. If I tell you in India, like every second guy is a option seller in India. Like from 2021, basically after COVID, the VIX in India went to like 80, 85. And after the vol started coming down and a lot of people started selling option, it was like a holy grail. You sell the option and you easily capture 85% of the premium. And everybody thought, oh, okay, it's a next holy grail. Everybody started selling option. And people made good money in 2021. Okay, in 2022, people made decent money. And from 2023, the vol went so low in 8 to 9 weeks, nobody made money and people started losing money. And even the same scenario is now. Everybody is option seller now. So there is no vol to sell. I think the risk reward is doesn't matching anymore. And you also know that like there are a lot of YouTube channels. People just tell you to sell covered call, covered puts. You just buy this. You can make money this way. Okay, this is a passive income. Then a lot of this has come, right? So, so, how do you think these kind of things are affecting the overall volatility risk premium because of the short vol strategies from retail? Even I think a lot of institutions have come into this. And if you remember, after 2008, there's a huge rise of these sellers, right? Vol sellers. So, how do you think these affect the volatility risk premium, and how this flows actually take away the whole risk premium in the market?
Yep. So a little history of option selling starting in the U.S. So up until say the early 2010s, option markets were smaller and were more dominated by hedgers, and so implied volatility tended to be more expensive, and there tended to be more volatility risk premium. Starting in around 2012. That you started to see the big pension fund consultants writing white papers explaining volatility risk premium, back testing covered call strategies and cash secured put strategies, showing those to their pension fund clients and trying to say, look, you guys should put some big allocation to diversify your equity exposure, do some option selling instead. The pitch was basically that you get equity-like returns with less risk, right? And so they started to have a lot of success with that around 2012 or 2013. And you started to have, big pension funds allocating meaningful amounts of money through big managers like Neuberger Berman and Parametric to systematic option selling, cash secured puts, covered calls. That grew and grew and grew. You started to see retail also get more and more interested. Some of the big strategies like in iron condor selling that UBS Yes and Harvest and places like that run. And what ended up happening was the volatility term structures started to, and all of this option selling, by the way, was typically benchmark oriented short term, so like 1 month maturities. And there's a couple of benchmarks. SIBO has a benchmark called BXM index that's for call writing, and then PUT index, put index for put writing, 1 month. A lot of those firms were benchmarked to that. And so you saw the volatility term structures steepen and steepen and steepen because the front is getting sold so heavily, right? And the street and volatility managers are having to supply the front and then hedge with longer dated options largely. And to your point, what happened was the volatility risk premium fell and fell and fell and fell and fell until by, call it 2017, 2018, there was basically no volatility risk premium left. And then again in 2019, through COVID, what you would typically see is if there was a sell-off in the market and implied volatility spiked a lot, there for some period of time after that, there would be some volatility risk premium because some of the shorts would get scared off or blown up. And so like after COVID, for example, you did have a reasonable amount of risk premium in the market later in 2020 and 2021, right? When, markets were still repricing, a lot of those shorts had gotten blown out. But then, we have very much come back, full circle. Again, the sizes of these programs are very, very large. They only sell, there's very few buyers of like 1 month volatility. And so it's a classic example of, the end users of vol are not hedgers in that part of the market. They are they're sellers for yield or for whatever you want to call it. And the result of that is that they're making very little money. If you go back and look at covered call and cash secured put strategy performance in the benchmarks, after about 2012, they dramatically started to underperform equities, both in absolute terms and on a risk-adjusted basis. And it's kind of like the out-of-sample period for a back test, right? The previous performance of those strategies, you really didn't have anybody selling options in big size, and so the performance looked pretty good. Once you had the market start selling options in really big size, the performance got dramatically worse because now ultimately option markets, even big S&P option markets, they're quite liquid, they're quite large, but they're not a primary market. It's not designed for 20% of global pension fund assets to go sell options, right? That's crazy. And so you've very much swung too far on that end of the pendulum.
Okay. Also, do you think a lot of QIS products came out because of these wall selling, right? A lot of banks came with their QIS products. So that can also be another reason that we saw this short wall coming up. And do you think because of these short walls, the pension funds got their hedge at cheaper price because everybody's selling while the wall is low, so pension funds are able to buy the option at cheaper price to hedge their tail risk? Or do you think because it's you can take it up the flip side that because of these institutions they buy put, so because of that you get a richer put premiums in the market?
Yeah, so QIS strategies are another contributor. They're not as big as the traditional overwriting and underwriting flows, but they are significant. And in some cases, they've also sold tail risk like variance swaps and things. There's a lot less of that after the pandemic because they lost so much money in the pandemic. But so you definitely see QIS strategies that banks are running, and they go across asset classes also. So that's important. So like they'll sell oil volatility, they'll sell natural gas volatility, they'll sell currency volatility. For a while in 2017, natural gas volatility got down to like half of the level where it had ever traded before because of QIS selling. And natural gas options, it's not that big of a market. So if billions of dollars start showing up in QIS strategies selling natural gas options, like it drops the ball a lot, right? And then you had a huge explosion in 2018 when the winter was a little bit colder than it was forecast, and natural gas went crazy, and you saw the optionsellers.com guy blow up and all of that, right? So yeah, it's definitely meaningful for sure.
Also,
and then you asked about hedge. You asked about hedges. So pension funds do some hedging. I would say not necessarily that much. It really depends. But they don't take the other side of the overwriting and underwriting flow or QIS flows. Really, generally, it comes down to again the concept of the volatility surface. Usually, those overwriters and underwriters are at the 1 month point. They're selling short term options for yield. and theta and so forth. Typically hedgers are further out. So 1 month feels too short and like it's, too timing dependent to a typical pension fund like portfolio hedger. They're more often buying, 6 months or maybe buying 1 year or something like that, where they don't really have a very specific view. They're trying to just own some volatility and convexity to defend against, a big market sell-off, and they don't want to be constantly rolling it. They don't want to be managing a portfolio of it, that kind of thing.
Also, if you remember in 2022, there were a lot of tail hedging program which had a lot of losses, right? So what do you think that because with a lot of institutions who buy these puts out of the money puts and everything, do you think it's basically worth buying those to hedge the risk, or it's just expensive premiums which they're paying, and uh, like which is worth doing those, like buying those insurance basically out of the money options to hedge the risk?
Yep. So when you think about tail hedging and managing market sell-offs, it's very important to keep in mind the different kinds of scenarios and different kinds of paths that can happen, right? So traditionally, when you think about tail hedging, options-based, derivatives-based tail hedging, you're usually thinking about strategies that are going to perform very well in a sudden, sharp market crash, like COVID or like the great financial crisis. Generally, it is much harder to structure derivatives-based tail hedges against like a very long bear market, for example, right? So if 2022 was sort of a low volatility sell-off for a full year. You could remember like the tech bust, which was like a relatively low volatility sell-off over like 3 years. You can't really buy puts that protect against that because you're going to be paying for those, and you're not really experiencing a lot of volatility. The market's not moving quickly; it's getting reversing. Really, the best strategies for there are ways to make tail hedges somewhat more robust to those paths, but they're never going to be optimized for those paths, right? Really, the things that do well in that scenario, things like trend following, right, where you have a long-term slow bear market and your trend strategy gets short and just stays short and monetizes this kind of move. So often, tail hedging paired with trend can work better in these kind of paths.
Okay. Next thing, like there's a huge craze over zero duty options, right? Huge volumes in zero duty options. Even India we had, but our regulator, what they did, they just moved all the expiries to same day. So you don't get different index expiries on different days. So you trade zero duty on every index because we had a huge flow of zero duty. And if you know, Indian bank Nifty was Indian derivative market had the biggest volumes in the world. We were like biggest, like our next was basically way lower than us, the volumes which we are creating in India. So even in US, you have zero duty options, right? So does this ultra short options create any meaningful flows for risk manager or the broader markets? Do you think that these short term option make hedging cheaper? And also some worries that these zero DD option could amplify intraday volatility or crashes. While other thing that it's mostly like even if you read, I was reading this one article by COB, right? Chicago. Sorry, CME Group, Chicago Merchant Exchange. I had that. So they were explaining how zero DTs are very less in terms of total overall volume of the market. So do you think a lot of people just keep criticizing zero DT that okay, one day because of zero DT we'll have huge intraday volatilities, or we might have some kind of an impact on the market? So what is your take on the overall zero DT thing?
Yep. So there's a couple of major sources of zero DT flow. So you have intraday directional traders who are largely buying options to get intraday exposure with leverage, right? So and those are both retail investors and large hedge funds, the whole gamut. So they might buy calls or call spreads or puts, and then you have option sellers for yield. There's even some ETFs that do this, and there's various strategies where maybe they own equities, but every day they sell zero DT option for yield against it, or they sell the cash secured put every day for yield. And because one of those flows is net buying, one of those flows is net selling. They're both relatively large, but it's not a market where there's like only buyers or only sellers. There's two-way flow that pairs off, and so that reduces any kind of material impacts on the market, right? The biggest distortions of market pricing and market action really come when you have one-way flow, right? When you have basically dealers and volatility managers being the only buyers, the market is the only seller, and then we have to all delta hedge these products and push the market around. That's not really the case in zero TTs. There's buyers, there's sellers. There are some kind of crash tail sellers in decent size, but they're supplying, and they supply Wall Street and vol arbs with really low strike hedges. So in general, I actually don't think that zero DTs are most of the time are causing very large dislocations. There could be on given days, maybe outsized flows one direction or another, but again, it's mostly two-way flow. And then the other thing that is very heavy use of zero DTs is managers and option market makers who have very large complex portfolios. Just every day we can manage our gamma risk profile really easily, right? So it's like, oh, we're a little bit too short gamma in this strike range, a little bit too long gamma in this strike range. You can just trade a little bit of zero DTs and kind of clean everything up very easily, where you didn't used to be able to do that. And again, that's a market efficiency enhancing kind of thing. So I'm really not very concerned about zero DTs in general. Now, do retail investors trade them too much and kind of lose money? Probably. But in terms of like impacts on the market, I think it's less.
Okay. So next thing the next section is we have on delta, so dealers and hedgers. So there is a lot of popular, like there's basically narrative, which is popular saying that the positions of dealers actually drives the market moves, right? Let's say dealer is a short gamma, so we can expect a sell-off to get amplified. But you have argued this in this model is extremely naive and often not even directionally true. So could you clarify why simplistic views of all investors buy put dealer short gamma is flawed, and how can actual dealer positioning sometimes be the opposite? Say dealer is long gamma or long vol in a decline, and what does the mean for the impact? Like what does it will have the impact on the market?
Yeah, absolutely. That's a very good question. So let's do a couple of examples just to kind of make it very clear. So first of all, to your point, people talk a lot about dealer gamma. Dealer gamma is actually important. It's just that there are some naive models out there which are wrong, and you just have to be to understand what do you know and how do you know it, right? And so when you think about dealer gamma, the thing that's wrong is that the old models people used to describe basically assumed that dealers are always being sold call options by overwriters, and they're always getting lifted on puts by hedgers at any maturity across everything, right? And as a result, your model would say that dealers get shorter gamma on the downside and longer gamma on the upside, kind of always in the same way. This is very naive. There's a huge amount of downside put selling also, especially in short dates. It's not nearly so asymmetric. It varies over time. And if you just assume this and you kind of look at the open interest and make these assumptions, it's total nonsense, right? Now, more recently, there are actually data sets from SIBO that you can get that tag order flow by customer type. When is there a customer that's selling to a market maker and so forth? And so actually, if you have that data, you can construct a much more accurate and detailed picture of what dealer positioning potentially looks like. And so that that can be meaningful and useful. So let's suppose that dealers are very long gamma today. What that implies is as the market rallies, dealers and volatility managers like us, we will get longer delta as the market rallies. And we'll have to sell it at the end of the day or continuously throughout the day to re-hedge our positions. And so that will create some mean reversion in daily price action, right? Same thing, if the market sells off, we'll get short, we're going to have to buy, right? So and because of all the overwriting flow and underwriting flow, that tends to be the natural state of affairs, is that volatility managers and dealers tend to be long gamma. Now, in particular circumstances, you can get into an environment where dealers are net short gamma. Maybe if the market sells off a lot, kind of into a range where many more hedges are, they're far away from all those strikes of the overwriting calls that people have sold. Then the opposite is true, right? Then if markets are selling off, dealers are getting long, and dealers have to sell into that sell-off and amplify that move. So then you tend to get more momentum intraday, right? And vice versa. Now, people that's I think the simplest way to think about this. So again, it's meaningful. Like these gamma effects can be very large because option sellers are so big most of the time, but you do really have to actually have the right data and do the right work and build the right model. You can't just make kind of naive assumptions about about the what the flow looks like.
So, can you just sum up this in a, if you have to summarize it, so how would you summarize the whole thing in a very short paragraph if you have to explain to someone? Hello?
Hey, sorry, I just lost my headphones for some reason.
Okay. Yeah. So I was saying if you have to summarize it to someone in very short, with this very short, short information, like short summary. So how would you explain it? Like points, like this, like a points in points.
Mm-hmm. Yep. So when dealers are long gamma, it means that the market will be more mean reverting because we
Yeah.
have to sell when the market rallies and buy when the market sells off. And then the opposite is true. If dealers are short gamma, markets will tend to be more momentum-y.
All right. So next question is, I have more on the positioning side. So you gave an example where hedge fund and asset owners were net buyer of calls, worried about missing a rally, so which led to extremely low index Q and low portfolio correlation. Basically, the opposite of the usual assumption that everyone is buying puts. How often do these regions flip in the positioning like in flips in positioning happen, where you see currently in terms of dealer position and its effect on volatility?
Mm-hmm. Yeah, I mean, you can see that, relatively often, and you can see it pretty simply if you just track skew over time. Typically, again, if skew is very high, probably dealers are relatively short, downside. If skew is very low, it's probably the other way around. You'll see it in market behavior, right, where there'll be the market will be tech stocks will be rallying and you'll see some really big trades in upside calls going up, right? And skew will flatten and the market will tend to trade more volatility to the upside. 2021 was a great example when like SoftBank was out there buying huge options positions in the big tech companies and skew was flattening very dramatically and you were getting, volatility rallying to the upside. And then you get event, and then after a few months you get a sell-off and people flush out that positioning and bid skew. So it the nature of flows definitely change several times a year.
Okay. So next, I want to ask on the Vana and second on the Greek side. So there are a lot of sophisticated traders who talks about Vana and charm flows. You even defined Vana as a cost partial derivative of an options value with respect to spot and implied volatility. For the quant minded listeners, can you explain in plain language why Vana and charm matters and how do change in volatility or the passage of time force dealers to rebalance hedge in ways that can move the underlying market? Perhaps walk us through a scenario, for example, like market rallies that cause implied volatility to drop and how Vana effect might lead dealers to buy or sell stock.
Sure. So just very simply, let's suppose that dealers are short downside puts and long upside calls, right, for example. So then dealers are long Vanna. In other words, they're going to get longer delta if fixed strike implied vols go up and vice versa. So if we have a market rally that causes fixed strike implied volatility to drop, then dealers are going to get short delta and have to buy stock. So they're going to amplify the rally. Now, so that's kind of the Vanna effect. Now, let's assume the same position. So dealers are short the downside, they're long the upside. And then imagine time passing and the market staying around the same. So what's going to happen is their long delta on their short downside puts is going to fall. It's going to decay. And the long delta on their long upside calls is also going to decay because they're out of the money. And so the dealers are going to get shorter delta overall as time passes, and they're going to have to buy stock. So that's the charm effect. Now, the one caution that I would make here, these are higher order Greeks, and the actual quantitative impact of those dynamics that I just described is like, orders of magnitude smaller than the impacts of gamma, which is much larger and more meaningful. I would be careful about overstating the impacts of, Vanna and charm on, market direction. I think it's pretty small in most scenarios. But again, it's worth understanding.
Okay. So now let's talk about the structured products. For instance, popular yield notes in Asian and Europe market that involves selling index options like auto calls or clitlets, or you can say some other product. These products lead dealers to carry large part dependent hedges. So how do such flows impact the volatility surface? For example, do they contribute to persistently lower index Q or strange behavior in the certain market? In short, how aware does a vol trader need to be of the exotic flows from the structured product desk and their hedging activities?
Yep. So the biggest flows in structured products tend to be products that you refer to as auto-callable notes. There's many different varieties of them, but typically the basic idea is that the investor is getting a coupon, maybe 20% per year or something, in exchange for taking the risk that the underlying, or sometimes it's a basket of underlyings, falls a lot. And if that happens, they're going to lose a bunch of money. Right, so they're basically selling crash risk to get a coupon, right? And usually those are barrier type of options. So they're very kind of nasty in terms of how they are hedged, and the net impact of that, right? So the first thing that a dealer does, that a structured products desk does when it issues these notes to clients, is it has to hedge them, and they're going to go sell long dated downside options to hedge them, right? And so that is going to push down long-term volatility and push down long-term skew. And then when they dynamically hedge those products, as the underlyings fall, because of the nature of their exposure, they're usually going to get net long volatility and have to sell more volatility at first as the market falls. That's going to keep that long-term vol from going up too much as the market falls. But then because these products are barrier options, like effectively knock-in puts that they're short, that eventually, as you get close to those knock-in barriers, then the dealers actually are going to lose their vega on their longs, because when one of these notes knocks out, it just terminates, the client loses some money and the dealer has no more position. And so they still have their hedge, they have to buy back their hedge. Right? And so what that means is once the market goes down far enough, then they have to stop selling volatility, and eventually they have to buy a lot of volatility to cover all of these hedges. And so it creates this very funny dynamic in the market that suppresses spot vol correlation at first until there's a big enough move, and then it amplifies spot vol correlation a lot and returns it to normal and bids the wings very heavily.
So, do you think we can incorporate these flows into our model? Like, can we make it? Can we put any quantitative method or quantitative assumptions in the model to incorporate these flows, like exotic like flows from these products? Is it possible to incorporate these in the model?
Yeah, so you have to know, you have to have a reasonable idea of the sizes of structured product issuance and of the strikes and of the underlyings. You can get that. Every month from some of the exotic derivatives dealers will publish that kind of data. You don't necessarily have it in real time. You don't have a whole picture of everything. You only have what data you have, but you can certainly construct a framework for trying to estimate what impact those products will have over different strike ranges as the market falls, for sure.
Okay. So next, I want to talk about hedgers versus speculators. So I remember in one of your tweets, you have talked about the concept of non-economic hedgers, players who hedge as a mandate or a reason unrelated to profit maximization, like a $2 billion portfolio that must maintain a certain risk level. And how do you identify those flows, and what opportunity do these flows create? At QVR, do you use it as a part of a strategy, essentially to take other side of the positions? Like if you know that these kind of flows can come, so do you take a similar position, or do you think someone can take a opposite position to these flows to make profit out of it, or build a certain position from it?
Yeah, so we're always interested in dislocations in derivatives markets, right? And dislocations come from, price insensitive flows might be selling, might be buying, right? And we're always interested in what is becoming too expensive because of end users persistently buying something, and what could, if we were going to sell that, what could we hedge it with to make a nice relative value trade that has good risk characteristics and so forth, right? So, when you think about price insensitive, buyers of options, a lot of time, again, you see hedgers dominate, say, the 6 month to 1 year, 20 delta put range of the volatility surface, because that's, typically where a slower moving, pension fund might go to hedge. Versus you see, sellers dominating the long-term downside in structured products. You see the sellers dominating, the short dates. Same thing with certain parts of the VIX call market might be, dominated by hedgers. There were a lot of sellers of VIX calls before the pandemic. They got absolutely destroyed. There's much less, aggressive selling of VIX wings. So now they tend to be, more bought by hedgers. And again, when you see, for example, you'll see trades go up where, the 100 strike VIX calls are being bought in very big size or something, right? And that's never because somebody expects the VIX to go to 100, right? That's primarily because large institutional investors have a risk framework. They have a slide risk report that tells them how much money am I going to lose if the market drops 20% tomorrow, and they can't lose more than X or the margin. And so the cheapest way for them to deal with that might just be to go buy all those VIX calls, even though they know that they're going to expire worthless. It doesn't matter because it's the cheapest way to get them back within their risk mandate, right? And so understanding, that is important to thinking about why are people doing different things in the market.
Okay, got it. So again, it's part of dislocation, right? So when you build a dislocation strategy, so like QR specifically works on dislocation, finding dislocations from these flows and building a strategy or trade on based on these flows, right?
Yeah,
Okay.
so we have many different strategies. Every one is very specific, reflecting a particular relationship between different types of instruments, a particular kind of dislocation that we have a whole bunch of research around, and we understand what the flow is. And the portfolio is an assembly of those kinds of trades.
Okay. Next is basically on the macro and geopolitical side, like right, because of all the tariff and all the geopolitical situation of war and everything is happening, a lot of macro events and even these announcements of by certain politicians or some policy change does impact the overall volatility in the market. You never know what tomorrow tariff would be on China and what tariff the China will put on the US. You never know that, right? So do you think these like as a vol trader, these things will does matter for a vol trader, right? Because it impact the volatility. So how does a trader basically trade or incorporate these kind of events in their uh, in their trading, and how do they price mispricing among these events?
Mm-hmm. So yeah, markets do attempt to price macro risks, and they're pretty good on average at pricing regularly scheduled macro events like Fed meetings or data releases, CPI, like, unemployment report, all of those kind of things, right? Because they have a good data history on them. What's the range of outcomes? How do you think about, statistically, how much you think these different events or macro risks matter? Markets are less good at pricing like new and uncertain risks that are more qualitative. So you could think about the Trump tariffs, for example, and Liberation Day a few weeks ago, where we saw the market get that wildly wrong. Lots of people were betting that Trump was playing four-dimensional chess and he's kind of negotiating. He's not actually going to try to do this totally crazy thing that he said he's going to do, which I think was the wrong way to think about it. I think he absolutely was going to try to do that. He very much believed in tariffs, and he was kind of surprised by the market's reaction. And so we saw these 5%, 6% sell-off days. And so the market doesn't always get it right. Again, especially when it's something that is more nuanced, is more kind of judgment oriented. You can't really look at it quantitatively necessarily in any kind of specific way.
Okay, so let's take a recent example. Okay, so how did the options market react to the whole Middle East tension this year, and or the ongoing basically ongoing inflation? Then we have Fed policies. So did you observe any unusual shift in the wall surface say increased Q or term structure, kink in the term structures, or pricing a event risk. And let's say we like recently there was some cutoff date on which Trump was going to make an announcement, right? And so do you think around those dates we got some kink in the whole term structure?
Yeah,
And
those
are
events are
these
all, yeah. Oh, sorry, go ahead.
yeah. So more broadly, are these basically these things get reflected in the bond market as well, right? Bond volatility market. So can you give this example, like recent example on around these events? How did these events affected the volatility spectrum from wall surface to term structures and everything?
Yep. So, volatility markets always price every event very specifically. You just look at the term structure. You can extract exactly how large is the move that the market expects from that. For Fed meetings, you'll usually have some, in a quiet market where, let's say, implied volatility is 16%, assuming like 1% moves per day. With a Fed meeting, maybe that would go up to 2% or something like that, right? So the market's always saying, okay, look, here's a more meaningful event. We're going to price it. When you looked at the Liberation Day, Trump's deadline for imposing tariffs, there was event pricing for that day. But it was way less than the market actually moved, right? So again, it was more like two or two. It was moving around, but 2 or 2.5% implied moves, and then we were getting 5% moves, right? So, but yeah, there's very explicit pricing of every event that we know about in advance in the volatility term structure. You can extract it and kind of keep your table of events. It's the same with like earnings dates in single names, right? So like Facebook earnings is always priced. You can see exactly how much the market expects Facebook to move on earnings, and you can maybe have a view on whether that's too high or too low.
But also, we have a concept called volatility paradox, right, in the market. Sometimes vol is lowest when the risk seems highest. Okay, and vice versa. Why do you think in 2017, despite nuclear tension, political risk, had the market record low volatility while a shock like 2020 pandemic exploded the volatility? Have central banks policies or structured investors behavior contribute to disconnect between apparent risk and the implied vol?
Yeah, I think it really depends. So, geopolitical risk always sounds scary, makes headlines, people like to talk about it. It doesn't really affect markets meaningfully, right? So, like, there's some tension in the Middle East, or like there's a new invasion of Ukraine or whatever. Sometimes you'll get a little bit of a knee-jerk reaction, especially in markets that are directly linked, obviously, like the relevant bond markets, or maybe some commodity that has some very direct exposure to that conflict. So oil will move some on Middle East tensions. But, the equity market just doesn't care about that stuff, right? It doesn't affect anything about where you think the S&P should trade, and it doesn't really move it. Now, when you had in 2017, we had very low macroeconomic volatility, very low surprises on any front, kind of steady earnings growth, like nothing really going on, lots of option selling that made dealers very long gamma. So like it was very natural that, volatility was very low in that market. Now volatility got really extremely low, and there was a massive amount of vol selling and very risky behavior and tail risk selling and all this kind of stuff, right? Which, drove us to those extremes. But I think, you don't necessarily expect the various geopolitical tension headlines that come up in that environment to really change things very much. Just historically, again, geopolitics and political risk doesn't really matter for the markets too much.
Let's say there was a recent talk that Bank of Japan will increase the interest rate, which will again affect the carry trade, right? And a lot of people take loans basically because of carry trade. A lot of people have treasury positions, and because of that, again, it affects the whole equity market, the treasury. So, do you think this scenario will be priced in the equity options pricing?
When you have a specific event date, and if it's perceived by the market to be relevant, then it will always be priced in. If it's a more, nebulous risk about, well, this might happen at some time in the future, obviously BOJ has its meetings dates the same way that the Fed does. For kinds of risks that are just, vaguely out there somewhere in the near term or medium term, this might happen. You don't get as explicit of pricing in one particular maturity, but you might get a little bit of just a bump in implied vol because people are a little worried and maybe they buy a little bit more options or something like that. And it might feed through a little more into cross asset vol. So in this case, like dollar yen options, might meaningfully go up in price because those are very directly affected. Other things, the further away they are from that locus of causality, the less that it'll matter.
Okay. Do you think people can again monetize these kind of events in when they trade vol? Like if they like how what should be their approach if they want to monetize these kind of events, or even they should even try to monetize, or they should stay away from these kind of events to monitor and just sit on their positions like blank, like so just sit on cash.
I think generally trading events is very hard. It's very hard to think that you have again, especially with respect to regularly occurring events and things that the market knows how to think about relatively well. It's very unlikely that you're going to have a differentiated view from the market that's going to have any edge on this kind of thing, certainly as an ordinary investor. Now, obviously, I did say, on some big things that are more subjective, sometimes the market can very much get it wrong. So like on the tariffs, that's a good example of one where the market was just very dramatically underpricing the risk of Trump doing exactly what he said he was going to do and exactly what his advisors wanted him to do and all this kind of stuff, right? So I think there, you had a clearer case of the market just being wrong and, being able to take advantage of that.
Okay. And also, how do you think like how do you gauge if markets are like appropriately pricing the tail risk for a geopolitical event or a credit crisis? For example, if there is a risk of a major conflict, do you look at the skew or out of the many options prices to see if the tail is rich or cheap? Or and do you ever take position based on the view that market is too complacent or too panicked about a macro risk?
Yeah. So wings are, true tail risk is somewhat difficult to price in the sense that, like, take a credit crisis or, something really bad, right? It's very hard to know if the probability of this very bad event is like, 1% per month or 1/10 of 1% per month, right? I mean, like both relatively unlikely, like which of those is it? And that accounts for like a 10 times difference in what the price of that option should be, right? And so it's relatively straightforward. If a tail is kind of priced as if it can't possibly happen, like then it's pretty easy to say it's underpriced because lots of crazy stuff can happen that didn't happen before, right? Oil went to negative $42 and like VIX goes to 100. But it's very difficult most of the time to argue that a tail is too expensive because again, like how do you know if the probability is 1% or 0.1%? Like it's very, very difficult. There's no statistical analysis that you can probably do that's going to differentiate that. You don't see that many tail outcomes happen. It's a small data set. They all are different, right? So for us, we're generally not trying to say, oh, well, our model says that the tail probability is, 1% and the market's pricing it at 0.1%. So, or something like that. It's more understanding what the exposure that you might have is to a variety of different scenarios and making sure you're comfortable with like how that risk looks, making sure your portfolio will be fine. Paying attention to macro from a defensive perspective, right? So, okay, is there this big macro thing that's happening? What could happen, and will that affect our portfolio in a negative way? And how do we be protected against that? But we're not trying to kind of like come up with a model for exactly the right price of the tails and like buy some tails and sell some tails. That's very dangerous because if you're wrong about tail risk and then you're short some of it because you think it's too expensive, that goes very, very poorly.
Okay. And when we talk about tails, a lot of people talk about trading risk reversals, right? So what is your view on that?
I mean, it depends on the strike ranges. So a risk reversal would be, for example, buying an out of the money put and selling an out of the money call. I think of that more as a skew trade than necessarily a tail trade. But like, if you own very far out of the money puts, presumably you're long, the left tail, right? And you can think about how is, where are the flows? Where are the buyers? Are you getting, really cheap skew that way? In some market where there's a lot of buyers of calls and sellers of puts, like so for example in some of the more meme stock or retail favorite stocks, skew gets very flat because at the long end because of structured products that people buy on Tesla and things like that, Palantir. On the short end because of options trading flows, in that environment, it means you can buy the left tail fairly cheaply, right? Because you tend to have very low skew. You don't really have buyers of puts for hedging. They're all buying calls instead.
Also, now I think we are at the end of the podcast. Before we record a second session, which will be more interesting, I think. Yeah. So I just wanted to ask one last question. Okay. So uh, a lot of people are now trading options, and a lot of people retail want to trade right? Volatility trading and stuff. So what is your few wisdom and like few thoughts that you want to give it to them? Like what mistake they shouldn't do, or what are the things they should focus on if they are trading vol as a retail? Because there is a huge difference between trading vol as a market maker or as a trader at an institution as compared to trading as a retail. So what
Yeah.
is your advice to them?
So my first advice would be, don't try to trade options in volatility. I think that's the safest way. That's the safest thing to do.
Okay.
Now, if you really want to, I think a couple of things. One, you need to be very careful about execution. So pay a lot of attention to what is the bid-ask spread, and not just, lifting offers and hitting bids, but trying to put, small orders at mid-market and let liquidity come to you. I think that the easiest way you lose money over time is just by not really having an edge, but paying too much transaction costs. And then, your account just goes down. So that's one thing. Another thing is, don't listen to YouTube options influencers and all these people, right? They just tell you to sell volatility because it should always be profitable, without thinking about what is the price and what are you really doing. There could be times to sell options, and that's fine, but you really need a good trade thesis about how much am I getting paid to sell this option? What's the risk of loss? Is that a good trade-off? Not just blindly doing covered calls or cash secured puts. Again, you hear lots of bad advice about that on the internet. And then to do try to stick to relatively safe trade structures, right? So if you could imagine, if you have a directional view on a stock with some timing, maybe you really like earnings, you think they're going to beat earnings, you could buy a call spread or something where exactly how much money you're risking. I'm risking $3, and I know I could make 4-1 if I'm right, and so I like that bet. Like that's pretty safe. That's pretty easy to evaluate. As opposed to trying to do really complicated trades, or constantly trading super short dated options for leverage or something. It's very easy to lose a lot of money if you're not being careful.
Thanks. Thank you so much for your advice. Uh, Thank you so much, Ben, for your time. I look forward to our second session. Uh, Thank you. Thank you so much for giving your time.